All right, let's talk about that financial alphabet soup. FDIC, SIPC, the Fed, the Treasury. It's a lot, right? It's confusing. But the real question is, who actually has your back when things go sideways with your money? Well, in this explainer, we're going to cut through all that noise and make it super clear. You'll know exactly who does what and why it matters. Let's dive in.
So let's start with a really common situation. Imagine you've got your money in a big, well-known bank. You've got a checking account, and you also bought some stocks through their brokerage service. The stock market takes a nosedive. Is your money insured? The answer to this gets to the heart of probably the single biggest misunderstanding in personal finance. So let's clear it up right here, right now. But before we can answer that, we gotta zoom out a little bit. We need to talk about the two giants of the U.S. economy, the Federal Reserve and the Treasury. A lot of people think these are the guys insuring their accounts, but their job is, well, it's way bigger. They're looking after the entire system, not your individual portfolio.
First up, the Fed. You hear about them on the news constantly, right? They're the ones always talking about raising or lowering interest rates. Well, their whole job is to manage the country's monetary policy. Basically, they're trying to keep the entire U.S. economy steady and on track. Think of them as the architects of the whole financial system, not the security guards at the door.
And this right here is a really, really critical point. The Fed's decisions, yeah, they can absolutely move the markets and affect your investments, for sure. But they don't regulate the brokerage firm where you actually buy and sell your stocks. Here's an easy way to think about it. The Fed kind of controls the economic weather, but it doesn't inspect each individual boat to see if it's seaworthy.
Okay, next up we've got the U.S. Treasury. The easiest way to think about these guys? They're basically the CFO of the entire United States. They handle the government's money, and to do that, they issue some of the safest investments on the entire planet. Things like T-bills and bonds. The stuff that's backed by the full faith and credit of the U.S. government.
So what's the key takeaway here? The Treasury creates and sells these incredibly safe investment products, but, and this is a big but, it doesn't regulate the companies that sell them to you. It's like they bake this really safe, reliable bread, but they don't regulate the grocery stores. That's someone else's job entirely. Okay, so if the Fed and the Treasury aren't the ones directly protecting your personal accounts, who is? Well, this brings us to the main event, the big showdown, FDIC versus SIPC. And it all boils down to one simple question. Is your money in a bank or is it in a brokerage?
This chart is everything. It breaks it all down. Over on one side, you've got the FDIC, it's a government agency, and it protects your cash deposits, your checking account, your savings. If your bank fails, the FDIC steps in to make you whole. Now on the other side is SIPC. It's for your brokerage account. If your brokerage firm goes belly up and your stocks somehow disappear, SIPC is there to help get them back for you. But, and you got to focus on this bottom row here, because this is where everyone gets tripped up, the FDIC does not protect your stocks, and SIPC does not protect you from just making a bad investment. If you buy a stock and it goes to zero, that's on you, not them.
So how much money are we talking about? For the FDIC, that magic number is $250,000. It insures your deposits up to that amount per person per insured bank. And that's key. It means you can actually get more coverage if you have different types of accounts, like a joint account, or if you just use different banks.
Now SIPC's number looks bigger, but it's a little trickier. It protects your brokerage account for up to $500,000 in total, but, and here's the catch, within that $500,000, there's a specific cap of $250,000 for any uninvested cash that's just sitting in your account. That little detail is absolutely crucial to know.
And this brings us right back to that question we started with. This quote says it all, perfectly. Just because you buy a stock through your bank, maybe on their app or website, does not mean it's covered by FDIC insurance. An investment is a security, it's not a bank deposit. That means it falls under SIPC protection, which again is for firm failure, not for market losses.
Okay, we've covered the big federal players. But wait, there's actually one more layer of protection that's working a lot closer to home for you. State regulators. These are the folks who enforce what are called blue sky laws, which are basically laws designed to protect you from fraud right there in your own state.
Yeah, these state agencies handle all the nitty-gritty. They're the ones who watch over the local investment advisors, they manage certain investment offerings within the state, and they handle all the really important stuff like licensing and registration. You can think of them as the local cops on the beat, making sure all the financial pros in your town are actually playing by the rules.
Phew, okay, That was a lot of ground to cover, right? We had the Fed, the Treasury, FDIC, SIPC, state regulators. It's a mouthful. So let's just boil it all down into one simple, powerful cheat sheet to make sure all this stuff really sticks.
This right here is your cheat sheet. Seriously, if you remember nothing else, remember this. FDIC protects your cash in the bank, not your stocks. SIPC protects you if your brokerage fails, not if your stocks go down. The Fed influences the whole market but doesn't regulate your broker. The Treasury sells government bonds, doesn't regulate the industry, and state regulators, they're the local cops. Every single one has a very specific job. Knowing who does what is step one to being a much smarter and safer investor.
So now you know the playbook. You get the key difference between what happens if a bank fails versus a brokerage failure. But you look around. The financial world is changing so fast. We've got crypto, all kinds of new financial tech popping up every day. And it leaves you with a really big question. Is this whole system, which was built for another time, really ready for what's coming next? Now that's something to think about.